Hello, everyone. Thanks for joining me again in our discussion of the stock market and how it's valued and the various signals that can help give us insight into what's going on. So the signal we're going to discuss today is the Buffett indicator. So what is the Buffett indicator telling us? We're going to look at this indicator alongside 5 other things. So this is video number 2 in a series of 6. The first one we talked about the CAPE index, and we determined that it was showing us that the market is overvalued, but we gave it a yellow rating. If you want to understand more about that, you can watch our prior video. Today, we're going to dive into the Buffett indicator, and at the end, give it a color rating, red, yellow, green. And then we'll dive into the environmental factors because the valuations are showing us that the market is overvalued. The environment will tell us whether that's supportable or not. It might be appropriate for things to be valued the way they are, given these 4 signals. And so that's where, when we put it all together, we're going to have a scorecard and we're going to quantify each of the 6 signals and then give ourselves an overall rating of risk. And the objective isn't to necessarily predict when there's going to be a stock market correction or crash or when there's going to be a stock market surge, but it is to kind of help us look, into the future and evaluate whether we think over the coming years things are going to go up or down and make good financial decisions accordingly. And basically understand our risk better. So with that, I'll try to speed things up a little. So the Buffett indicator, is it still relevant? Some people are saying it's not as relevant, but I disagree, and you'll find out why. But so yes, I say it is absolutely still relevant. And who agrees with this assessment? Wall Street Journal, Academic Research, Quantpedia, Warren Buffett himself. So there's lots of studies that have been done around this that indicate it is pretty good at forecasting future returns over longer horizons. It's not good at telling you what the stock market's going to do in the next month, so the next 6 months, but it has 87% accuracy of forecasting whether things will go up or down over a longer horizon, like the 5 to 10 year horizon. And the reason it's 87% is because they did studies on 69 different countries. And countries behave slightly differently. So that's why it's coming up with 87% there. So what is the indicator? How is it calculated? It's simply the market value of the U.S. stocks, not just in the indices, not just S&P, not just Dow, not just NASDAQ. It's all stocks in the U.S. Attempting to come up with the overall value, and that's divided by our gross domestic product, GDP. So it tells you what's growing faster, the market or our overall economy. And it's presented in a percentage. And so this just gives you some historical anchor points to show you what was high, what historically has been high, and what has historically been low. So 35 was quite low in 1982. Warren Buffett would have said, oh, this is a great time to invest because things are undervalued. You can see 90, 55, and then .com is about 150. And the reason there's ranges here is because there's different ways of calculating GDP. There's different techniques. So depending on which technique you use, you get a slightly different value. But the key thing is you can see the overall trend that we're talking about here. 2009 went down. Of course, there's the 2008 correction, or whatever term you want to use for that time period. And then it peaked around, in 2021, around 200. And today it's even higher than that. So historically, it is quite high. And if it is so high, if it's at like a near all-time high, shouldn't we be selling our stocks? Like, should we be freaking out? So what I would say is that, yeah, over the next several years, there's an 87% chance that things will go down. But it might not be as inflated as the numbers indicate. And I'll talk a little bit why. So GDP historically has gone up. Look at our economy. It just continues to grow. It's really quite remarkable. And so over the same period of time, the stock market is not as consistent. It goes up and down. And so when you look at the Buffett index, you can see it got quite high around the .com, and then we had the correction, and then it's been climbing ever since 2008. And so what Warren Buffett has said is, if it's over 120, consider that red, like beware, things are overvalued. And then if it's below 75, green, buying opportunity. And of course, this is not talking about individual stocks. It's talking about the market as a whole. There could be good buying opportunities, even though the Buffett index is in the red. There's plenty of stocks that have been beat up this year and have quite low PEs. And there's usually stories around that. AI is changing things. People are picking winners and losers. Like Accenture, for example, I think people are skeptical that consulting is going to continue to grow at the rate it has historically with AI. And so that stock's been beat up, and the PE is I believe it's under 20 now, in the teens. And so it looks like there's still good deals out there, depending on what you think is going to happen to the market due to AI or due to tariffs. So the reason, just going to, as I mentioned, the reason some people say that this number shouldn't freak us out as much, and we may want to raise this line to be considerate red, is because a lot of the companies that are included in this index are now global companies. They were more US based in the 80s, and now they're global companies. And so their market value reflects a larger environment than just the US GDP. So they're valued based on their global impact, but we're only in the denominator using the US GDP, and thus things aren't as red or as bad as people may think. So that's one argument for why our current environments could support higher Buffett indexes. So what does this mean? Should you buy or should you sell? Neither. It means you evaluate stocks individually. But if you're thinking of buying an index fund, things are pretty expensive right now. So keep that in mind. When the risk is higher right now due to the valuation of the market. It doesn't mean it's about to crash and that there aren't good deals out there, but it does suggest market returns over the next several years won't be as strong. Risk is higher than normal. Volatility will probably be higher than normal. So what color rating, what stoplight indicator do we give the Buffett index? I would agree with Warren Buffett, especially because it's at near an all-time high. We'll give this an indicator, a red stoplight color, and we'll put that in our overall scorecard that we're building. But don't panic, don't slam on the brakes. Just use more caution right now. And if you're about to buy an index fund, maybe you wait a little bit, see if things start to correct, or look for better deals on individual stocks. So signal summary. As I said, we're putting together a scorecard that includes 6 items. The first 2 are valuation. The next 4 are environment. So clearly the market is valued quite high right now. We have a yellow on CAPE, a red on the Buffett indicator. But can these conditions, the money condition, macroeconomy, psychology, and leverage, support those higher values right now? Or will it support it now, but not for long? Because we want to keep an eye on if these 4 things are changing, because it's clearly supporting it at the moment, but maybe people are just getting greedy at the moment. So that's what's going to be interesting with the psychology. And also, it should tell a really interesting story as we pull this all together and build a scorecard and then quantify the impacts of all 6 of these signals. So with that, hopefully you stay tuned. Hopefully you continue to watch this series. And thank you for your time.